Welcome back. For those who are watching the recording, we've just had a very interesting break. We're starting slightly late on Dan Neilson's presentation. He's, of course, the author of the Student-Parted Substack, and he's giving us a 2022 recap of his extensive contributions there. We're all avid followers, so it's really exciting for us to see what he has in store for us. Dan?
Thank you, Jay. Thank you all for being here. Thank you again for the invitation once again to join the most sympathetic audience in the world for my writing and thinking. Glad to be here. There's been a lot of conversation. I have not been able to be at every session. I've enjoyed what I have been here for, but I know there's been stuff happening that I haven't seen. I'm glad that that's the case, because this is work for a lot of people, and this is one of the places where that work happens. I just hope I don't repeat something that has already been said, and I hope you'll let me know in the time for discussion if there are connections that I'm not yet aware of between what I'm saying here and the other things that have been happening here. I will touch on a couple of big picture points that came up during the DeFi session and during Borio's talk yesterday that I didn't feel I don't feel got a full airing at the moment. I'll come back to them here briefly. Most of you know me, maybe all of you know me in this circle. So let me just very briefly say a little bit about who I am. I wrote a book about Hyman Minsky that came out in 2019. I hope you will read it. It's easy enough to find. If you read it, send me a note, because it's really a pleasure to get an interesting question or a thoughtful comment about something that I spent so much time on. A couple of years ago now, I started in on this blog, basically. We call it different things, newsletter, Substack, but it's a blog called Student-Parted. Most of you know about it. I hope, if not, you know about it now, and I really would hope to have everyone signed up for that. It is fun for me to do, and the thing that makes it fun is to know that people are listening. So I hope you will. And the other thing that I do, which is on the visible surface of this work, is that I teach a lot. This year I have taught at Simon's Rock, which is my academic home for now. I have taught as a visitor also at UMass Boston. And as you know, if you read Student-Parted carefully, I have just got back from a visit to Morocco. In Ifran, Morocco is Al Akhawan University, where I was welcomed as a guest for their January term to teach a 2-week class. I call it Political Economy of Finance, which is one of the directions I've been taking this work over the last year, and which is very much the context that I would like to share with you. So that's who I am. Easy enough to find, and the Student-Parted is the easiest way to know what I think, because all of my ideas pass through Student-Parted at some point. There's also a deep inner layer here, which I find that most people are not that interested in. So I'll say just 1 minute about it, in case there's someone here who's curious. There's like a deep inside to how this work happens. And if you stood over my shoulder and looked at what I was doing, I think you might be surprised at what you see. I was able to identify 5 things that I'm doing minute to minute. I stay close to the data without losing sight of the big picture. I do that by reading the Financial Times every day. No, not necessarily every day, but 95 days out of 100, I know what is going on in the world at the small scale, and I try to hold on to what is happening also on the big scale. I try hard, as you'll see in today's talk and also on Student-Parted, to create meaningful and expressive visualizations. I do that using R, the statistical programming language R, which is an amazing tool. And it was actually Stephen Kinsella, who many of you know, who told me to work on R. And it took me the better part of a decade, during which R got a lot better, it should be said. But I use it constantly. And I would say, if you're interested in being close to the data, that learning R is a very good investment of your time. What you can see on that at the surface is pretty pictures, and that matters a lot to me. But there's some beauty also in the way that happens. You don't get to see that on the blog, but that's why I like it. I use accounting representations. No real explanation required there, but I mean T accounts. I figured out my ways of writing out T accounts. I'm sometimes wrong, and I certainly wouldn't want to suggest that doing the accounting guarantees that you'll be right. But if your accounting is correct, then you're only wrong in interesting and meaningful ways. And I find that advances the conversation, even when I make a mistake. That if the accounting is right, then the mistake is usually interesting and an opportunity to learn something. And I think we all probably know that. Everyone on this call is aware of that. I spend a lot of time thinking about writing because I would like people to read what I write. And so I try to write concisely, and I try to write as simply as I can, which I don't know if it's really simple in the end, but maybe it's efficient. I don't know. Some people seem to like it. It's the best that I can do, but it is. I want you to know that it's a lot of effort. The effort is in editing, fairly brutal editing. Sometimes you see about a third of what gets written. About a third of it makes it all the way to the final cut, because I want people to read it, and I find that people do read it. There could be more, but I'm not sure if there could be better people reading it. I have a great audience that really cares about what I'm saying, and they talk back in fantastic ways. And so I think it's going well in that sense. And the other piece of this is what I call legitimation through conversation. I don't have a lot of success. I've not had a lot of success getting things out in purely academic channels. But I'm also not sure that academic economists are a good way to verify one's ideas. I think they are trying to verify something else. And so instead, what I am trying to do is to test my ideas by staying in conversation with people, including you folks. If what I think and what I write allows me to talk to the people that I want to about the things that I want to talk about, then I think it's working. I seem to be accepted in a lot of those conversations. And so I take that as a good sign. And if I miss something, or I miss something big, or I get an idea wrong, then I count on people to tell me, and I learn a lot from those moments. Just as a quick aside, this is a group for young scholars, for people coming up as economists, and I would say it is worth thinking about what the minute-to-minute work is like. My minute-to-minute work is in R, is writing, is working with data, and I like it. 75% of my time is those kinds of things. And I try to do it in a way that I actually enjoy, so that most of the time I like what I'm doing. And I've been successful at that. So it's worth it to think about how it gets done and whether you like what that looks like. Today, I want so I have a visible surface and a deep inside. For this audience, I'd like to share the middle layer, which is to say, those ideas which exist in my mind and in conversation with others, but which are not yet so perfectly precise that I'm really willing to commit to them in writing, and a little bit speculative, where I think I'm right and I think I see it clearly, but I'm not sure yet how to say that to other people, that sort of thing. I think you are close enough to my work that you can follow me through the middle layer. If I'm wrong, I hope you'll tell me. But I'm certainly not promising to be perfectly and completely correct, but I am telling you what I think. So this is what I'd like to do today. If you look back on 2022 through a monetary lens, the big thing that you see is something like this, which is that this past year, around the world, central banks have started tightening interest rates, raising interest rates, tightening monetary policy, and pushing very, very hard. The longer back you go on this graph, the more extreme it looks. This has been an extremely rapid increase in short-term interest rates. So that seems like an important question, and I call myself a monetary economist, so I would like to understand more about what is happening here. And this touches on the point that we were thinking about together during the break just now. If you go into the central bank discourse, it is somewhat surprising to discover that this conversation is conducted very much in terms of statements about a picture kind of like this one. This is for the US, but central banks around the world are doing the same thing. These are price indexes. So the slope of these lines is the inflation rate, more or less. And central bank, the theory that central banks use is very closely anchored to the slope of these lines. And so in this past year, obviously, these lines have become very much steeper, and you can choose CPI or PCE, or you can look at another country and have a different measure. There are lots of ways to measure it, but the basic point is the same, that these lines are more or less well behaved most of the time. And since the beginning of the COVID-19 pandemic, for a range of reasons, they have become much steeper, and that seems to be a problem. I find this to be a strange way to conduct discourse about monetary policy, because there are a lot of gaps between the theory, which is all about the slopes of these lines, and the things that central banks actually do, which has so much more to do with money markets, in the case of the Fed with repo, in the case of other central banks with a variety of other kinds of monetary operations, in some places, including in foreign exchange markets. All of this is actually quite difficult to connect to inflation, and I find the academic discourse to be deeply unsatisfying on this score. So I have made a practice of, and this obviously comes out of years of work with Perry, collaborations of various kinds with people on this call and others that we know, to do a couple of things instead. The perspective that I would use to describe this, and so this is one of the things that I'd like you to take away from this, and it's exactly the premise behind the statement I was making to during the discussion a moment ago. Central bank communications are neither truth nor lies. They're lines from the script of the grand political economic drama. Central banks are actors, as are we all. They're playing a part, and so they speak these things into the world through the minutes, press releases, monetary policy announcements. And if you read them, as I try to do almost every month, what you see is a lot of conversation about inflation. I don't think that that is a true statement about what's happening in the world, but I also don't think it's irrelevant. At the very least, it's relevant because it's part of how central banks explain what they're doing, and that explanation is not neutral or incidental. The explanation is itself part of the activity of central bank. I would say that this statement applies also to the balance sheet, because, and I'm not saying that the balance sheet is fictitious, not at all. I think they have a bunch of accountants at every central bank who work very hard to put together a balance sheet, which is a real picture of something that's actually happening. But it's also a message about the world, and it's also governed by rules and patterns and norms. And so the fact that repo collateral doesn't appear anywhere in the central bank's, in the Fed's official balance sheet release, that's true. It doesn't appear in that PDF. Does that mean that it isn't credit? It doesn't mean that it's not credit. It is credit. We know that it's credit because there's collateral moving and it has to go back, or there's an encumbrance which is placed, which will one day be removed. That's a credit relationship, to be sure. So I say central bank communications are neither truth nor lies. We need to read them and think about why they're said. I'm a social sciences person, so let me say, as texts that must be interpreted. They're doing things, and we should read them, give meaning to them based on our knowledge and based on everything else that's happened, not literally, but as part of a script, a part of a drama of which we are all also a part. So to follow my own advice, I looked to the balance sheet, and I suppose it's worth saying that, you know, this is real. I think this is a real thing. It comes from the Fed's website. You can download it from Fred, as I do. But what is it actually, right? These securities that the Fed owns are themselves legal documents. Once upon a time, they would have been written on paper. You know, they are in fact promises, which is to say that they are words, texts about property rights and about credit relationships. So in the end, I do think we need to be very thoughtful about our understanding of language, discourse, argumentation, theory is present a little closer to the surface of these questions than I think we are used to acknowledging. And so understanding contexts and the meanings of words and the histories of words is very much a part of the work of economists. And this is not frequently recognized by most parts of the profession. If we look at this picture, and I try not to give a talk without at least once showing a picture of the Fed's balance sheet, you can see that 2022 was a pretty different year from 2021, and also from 2020. In 2020, we had huge amounts of balance sheet expansion on the Fed's balance sheet, $3+ trillion of new money. That's a huge amount of money. And so while that was happening, there was a lot of things to say because it was a pretty big deal. And in 2021, we had kind of steady state on the asset side, but an entirely new entry on the liability side, the overnight repo facility in this purplish color here, which grew to close to $2 trillion within the space of a few months. And so there was a lot to say on the liability side. By contrast, there has been comparatively less to say during 2022 about the composition of the Fed's balance sheet. The only thing that really happens in big terms is that we pivoted. We pivoted from expansion down to a pause, and then now into contraction or quantitative tightening, as it's sometimes called. So I think it was a quieter year in a sense. What I did figure out during this year was a new way to represent balance sheets, which I've come to love. It's a little bit data heavy, but once you get used to what it says, I find it to be an extremely informative representation of the Fed's balance sheet. Assets on top, liabilities on the bottom. The quantities are flows. Flows meaning changes in the balance sheet quantities. So for example, when lines are pointing outwards, up or down, up on the top or down on the bottom, that means that that entry is expanding. When they're pointed inwards, that means that entry is contracting. And so, for example, during the past year, you can see the pivot from quantitative easing to quantitative tightening in the asset side. And on the liability side, you can see considerably larger flows back and forth, routinely reaching 50 billion and in a couple cases $100 billion of flow on these various balance sheet entries, all on the liability side. So in May of 2022, a big contraction in reserves and a big expansion in the Treasury general account, probably associated with tax payments, while there was nothing happening on the asset side. Asset side was quite flat. Throughout the year, there's been a lot of movement back and forth on the liability side, which I take to be some evidence of unstable monetary conditions in general. And I think that when this pattern changes decisively, we will know it, because whenever that happens, it will be correlated with other changes, things that we'll be able to read about on the front page of the Financial Times. I would say for those of us who study central banks, this representation is really helpful. It is pretty fast once you know R. So I again will suggest learning R if you want to work with this stuff, or just crib mine and look at this and tell me what you think, because that would be another way to do it. I'm happy to provide this stuff. And once you have the mechanics working, I can churn these things out for every central bank whose data I have, and it quickly becomes more than I can analyze myself. So there's room for everybody here. Thinking about the Fed's balance sheet and the Fed's interactions with repo in particular has led from the quantity side, as we saw on the Fed's balance sheet, over here to prices. And this picture, there's way too much here for me to explain every detail. I've written about it. There's lots to say. Google leaky floor. Leaky floor is the term that I have given this. Let me just view it from the middle layer here, right? Where this is, I'm not trying to communicate something specific. I'm trying to communicate a way of understanding, a way of thinking about all this. At the beginning of this graph in 2020, you had interest rates hovering around the middle, well contained by the Fed's upper and lower bounds. And since that time, all of the private rates, these are overnight dollar rates, have all fallen down to the floor. So just in very general terms, what's happening here is that the Fed is pushing up rates that are trying to fall. The private rates are trying to get lower, and the Fed is raising interest rates and is pushing up from below. And you can see that all of these rates are sitting around the bottom. These are spreads relative to the overnight facility rate. So we're factoring out the increase in rates that's been going on during this time, looking at only the spreads, the arrangement of rates relative to each other. I'll make a tiny prediction here, which is that I think that when this graph, when all of the series in this graph rise up off the floor, meaning that the Fed is no longer setting a floor to interest rates, even a leaky one, whenever that happens, is going to be when we have something more like normal monetary conditions in dollar markets, and therefore in the global monetary system, global money markets. I see some signs that maybe there's an upward drift in the last few weeks here, and I've said that to people, but I'm not ready yet to commit to that as a assessment of what is actually happening. But I will say that when it does happen, I believe that that will be correlated with events that we will read about also in the Financial Times. So part of this for me is building an infrastructure, an apparatus that I can use that points me in the right direction pretty reliably, that extracts the information that's available and puts it in order where I can see it and where I can make some sense of it. And there's an element of waiting with this because, as I know from studying Minsky, you can be right for a long time, but people's attention is going to be on you on one particular day, and you will be ready for that day, or you will not be ready for that day. Probably some combination of that, right? But when things are quiet, I'm building, and it's because I want to know what's happening, but also because I expect that it will be necessary to be ready for something. And I don't know exactly what it is, but I bet that it will show up on this graph when it happens. For example, something that happened not long after our last meeting like this, just about a year ago, Russia invaded Ukraine, as we know, and that had a lot of consequences. And let me be clear that the principal consequence has been the destruction of life and built environment in Ukraine and the suffering that has gone with that. And I was teaching during that time, and it was my first time really teaching during a war. It was quite a moving moment. What on earth do I say in my economics class on the day that Russia invades Ukraine? That was a question I had to solve, and I don't know if I did it perfectly, but my students seem to appreciate having a place to talk. So for those of you who are teachers, I would say we teach a discipline that has to do with the world, and it is our job to speak to it directly, even when the thing at hand is a war. This war has had many dimensions and has quickly escaped the bounds of what any one person could say about it. My job, I think, like many of us here, is to follow the monetary thread, and so that is what I have tried to do. This has been an interesting conversation because very quickly, a lot of people seem to have opinions ready about what was going to happen next. The dissolution of the global dollar system, a multipolar world, the rise of the RMB, and so on. And I have basically stayed out of that debate. I have said a couple of things, but mostly I have said that I'm not sure. And if I've said anything, it's that I don't see the evidence that the dollar is going away, and so I think I'm in more or less the same camp as some of the key voices on this call. But I am interested in understanding the arguments, and I am interested in understanding what's happening, even if I think the future will be too difficult to predict. Really, it's going to depend on a lot of other things. But one place we could go is back to the beginning, because one consequence of this invasion has been an effect on inflation that in political economic terms, what Russia is doing to Ukraine has a lot to do with global commodity flows, and therefore with the prices of commodities, and therefore because central banks are so committed to the slope of the price level graph over time, it has a lot to say about what global central banks have been doing. So in keeping with the logic of spreads, I turned that first picture around by subtracting taking the difference between the dollar overnight rate and short-term policy rates in a few other places. And what this shows, I think, is that the US found itself in US global hegemonic power at the center of the global political economic system, found itself in a difficult market for real resources, for commodities. Things are getting more expensive. And the US is a buyer, is both buyer and seller, but on net, the US depends on a lot of imports, especially through commodities markets. On the other hand, the US is the seller of something, and they are the seller of the dollar, in fact, which is the world's money, and they have found a way to squeeze on that situation here. And in this picture, I think, shows what that squeezing has looked like. And if you look closely, what you see is that the Fed tightens. That's those vertical gray lines starting in March. The Fed tightens, and other central banks tighten a few weeks later, or sometimes they tighten in advance because they can see what's coming. So, with the exception of the Bank of Japan, an interesting case that I'm going to skip over for now. I'm trying to get my head around yield curve control, and I've almost got it. You'll see it soon, but not today. I draw a lesson from this, which I think is a big picture theme that I have tried to bring where I can into this conversation about the global dollar. The way I say it is the four-sidedness of transactions is actually quite hard to perceive. That it takes a lot of practice to recognize, especially macroeconomic transactions. It's quite hard to recognize that there are four things happening at once: my source, your source. Let's say my source, your use, my use, your source. It's hard to see all four. And what happens then in journalism, and even in quite smart people in public discourse, that their arguments devolve into double entry arguments or even single entry arguments, and are therefore either outright wrong, or if they're right for reasons which are very hard to stand on. Therefore, preaching to the choir a little bit here, it's almost always a good idea to write out the T accounts. I say almost always, but I'm not sure that there's a time when it's not a good idea. If we're talking about money, it's always a good idea. So, for example, I did this in the past year. This is just one piece of the global dollar story. There's a lot of pieces to that, and I'm not really trying to give a definitive view here. We're in the speculative middle layer, but I've spent some time on China, including during my INET days. And one of the things I came away with was just a simple map of the financial and productive system, let's say, within China, Chinese economy, if you like, real side and domestic side. Without going through the details at this moment, if you are coherent, and this is a quadruple entry consistent picture, it uses sources and uses accounting, which I think is necessary when you're thinking about macro flows. What you find is that this picture doesn't make sense without a big flow of credit from the rest of the world, which we know is by and large US dollar credit. So people have made the argument for the rise in the RMB, including friends of ours. And I think that there's a big gaping quadruple entry hole in those arguments, which is to say that this whole capital structure that China has built over many decades, and very successfully, a lot of people have been, their standards of living have been markedly improved by this, right? It is all built on a structure of dollar credit, and is actually not simple or straightforward to change the capital stock in such a way as to eliminate that dependence on dollar credit. It is an accounting error to skip over that part and to imagine that China can change its invoicing currency or change its financial currency unilaterally. It can't do it unilaterally. It can only do it bilaterally. And the other side is the dollar, and the dollar doesn't have, the US doesn't have to consent. I believe I'm in the same camp as Michael Pettis, who wrote a long Twitter thread the other day saying something more or less like this. I don't agree with everything Pettis says, but I think he sees the big picture in a way that's similar to mine. And he says, you need to see where China fits in this system. It's not free to change its position. Its position is related to the US and therefore to the dollar. And so global political economy, which is two-sided, and therefore financial flows, which are four-sided, are essential to making sense of this. I think we on this call are in a very good position to contribute something along those lines to this conversation. Following this China thread inevitably leads to some thought about the People's Bank of China, pictured here. I remember walking by it one time, I believe, in Perry's company, if I'm not mistaken, in Beijing. Here I want to touch on something that came up yesterday with Claudio Borio, and I felt maybe I didn't ask my question or make my observation clearly enough to get the point across. So let me try again. If we think about macro accounting, I raised the PBOC because they're creating this digital currency, the ECNY. Macroeconomically speaking, is not a big deal yet. The numbers are not big. But I think there are some big ideas here. And I would say, while we're thinking about macro accounting frameworks, let's take this on board. Because here's the piece that you should read. Okay, it's a short piece. It is not quite a policy document, but this person, Chen Yao, or Yao Chen, we might say, is affiliated with the PBOC. So this is a quasi-official document. This is a central bankers talking, okay? And what they say, if you read this paper carefully, what it says is that the central bank wants transaction level data so that they can conduct monetary policy by steering those transaction flows. They want to be able to promote certain sectors or certain regions, or even to a certain class of banks. They want to be able to fiddle with the knobs in the payment system itself at a very fine grained level. And when they say that, what they're talking about is monetary policy. It's not about measuring preferences. It's not about creating a statistical model of what people want and then using that to drive business decisions. It's not about that. It's about changing interest rates or fees or availability of services, or otherwise actually pushing on the system to create spending flows in one direction or another with one destination or another in mind. It is monetary policy. I think we are in a position to take that idea, build on it in terms of the financial mechanics, in terms of a global system, and think about what are central banks going to do when and if they gain the ability to steer at the transaction level, to steer what's happening. There's another piece of this. We know this is happening. I mentioned Amazon, okay, yesterday, and that leads one too quickly to the retail side. So let me give you a different example, which is Citadel Securities market maker. GameStop, you remember this from some time ago now, was that 2021? Citadel, the market maker, pays the retail broker for the retail broker to create an app which steers securities transactions in their direction. The wholesale market maker pays the retail market maker to create order flow, which they do by gamifying their app, right? So here is a private actor which is looking at the transaction flow and trying to adjust the pricing and the width of the channel. They're trying to adjust the spreads so as to generate flow through their market making operation, profit from the spreads, and they pay some of that spread back upstream, back to the retail market maker. So this is also a version of the kind of thing that I think we should be thinking about. Again, PBOC is doing it for its own reasons. Citadel Security is doing it for profit-based reasons. We don't need to accept their reasons. But the thing they're doing is transaction level quadruple entry accounting using fintech and using big data, and they're trying to control spending flows. So I think that it is a version of monetary policy. So if we say our accounting framework should follow from the kind of monetary policy we want to make, well, I think people are already trying to do that at the private level, or in certain official sectors, and it would be better for that to be happening in more places at the level of the BIS or at other big central banks where that can happen with a little more fresh air around it. And I think we could be part of making that happen. Last thing, and I'll try to wrap up in the next couple minutes if that's okay. Someone tell me if I'm overstepping my bounds, please. Crypto. I read a lot about crypto. I've become even known a little bit as I don't know, a reputable voice, as a valuable critical voice in the crypto world. Let me say this: we see versions of this picture quite a lot. Poor Sam Bankman-Fried. This is a sideshow. This is a sideshow. Don't look too hard. The guy made $28 billion and never stopped to think about what was really happening around him. I'm not sure that prison is the best result here, but I also don't think that it matters for the system as a whole. Let me say a couple of things. And I was glad to be part of the DeFi panel yesterday. I was also glad not to have to share my own ideas. I learned something from Sebastian and Rafael and Larissa. I think those are important questions to continue working on. I will point out this one thing that happened this year, which is that Terra, a crypto stablecoin, collapsed. To understand Terra, you have to think about both Terra and Luna. It is a lot of the logic of an automated market maker. It's based on a formula which is meant to keep two prices in line. One of them, in this case, unlike Uniswap, one of these prices is meant to be one all the time. And here's the interesting thing, is that it kind of seemed like it worked. You could be forgiven for thinking that it was working up until May 8th of 2022. You could be forgiven for thinking, this seems to kind of work. You got no variation in the price of Terra USD, and the connected coin, Luna, seems to fluctuate, and the function of that fluctuation is to absorb fluctuations in the other price. So you get a stable coin, and it's algorithmic. Nobody's work is required. The lesson that we really should learn is that it only took 3 days for that to break down completely, destroying, I think it was about $40 billion worth of wealth that had been put there, and making a mockery of the idea of stability. So there's a lot that we could say about that. Now is not the moment. Here's what I would say, and this speaks to the presentation earlier on CBDCs. It speaks, in a way, it's my provocation coming off of our DeFi panel yesterday, and I've been thinking about this in my own way a lot. Sam Bankman-Fried, FTX, this is not the thing we need to be watching. Maybe we can spare a couple minutes for it, but none of the big ideas behind crypto were actually tested in that failure. Tokenization, programmable contracts, composability, these are actually big and substantive ideas, and they were not ever tested by FTX. Therefore, systems that are getting built now in big private banks, inside the regulatory envelope, inside central banks, the world's central banks, the BIS is very involved. Now we see the Fed is very involved. It's still early days, but these same ideas are being used. They have not, in fact, been tested. I think that we need to be careful of where the tech ideology is leading. Tech has been very successful over some decades now, and you could see why they want to steer the monetary conversation as they do. They don't know what liquidity is. They don't have a lot of clear thinking about balance sheets, and they certainly have not had to live through a proper financial crisis with their ideas in the driver's seat. I think it is time now to build a clear money view sense of these ideas. Programmability, composability, and tokenization are three important ones. There are others. This is work for many people. I'm trying to contribute to it, but I'm saying this here because I think that we should do it together. We need a clear money view conversation about these ideas, and it would be helpful to have it sooner rather than later, because one day this system is going to break down, and the longer it goes on, the bigger that's going to be, and the more important our voices will be when that day arrives. So let's do it now so that we already understand it on the day that it collapses. Just to show you that this can be done in balance sheets. The balance sheet language is not the endpoint, right? For me, the balance sheet language is a step along the way. It is a way to clarify your thinking. It is a way to communicate your thinking to others. It's a way to connect with real institutions and the people who work at them. There's still interpretation required, even after the accounting is done. And I think we should be cautious about where we should be careful to think about where the balance sheet methodology fits into the process. The end result is what we say and the meaning that we give it and the communications that we have with each other, not the representation itself. That said, some representations are more helpful and others are less helpful in terms of moving that conversation forward. And so it is worth the time to make good ones, as I have tried to do, and as many on this call have also tried to do. And they look different, which is nice. I find some people use colors. I got a way to do it that's all black and white, but I really do appreciate the openness to different approaches and different looks for these ideas. I think that's a good way to get answers, and I like doing it, and I like doing it in companies. So I thank you for that. Last, and this is just about the end. I wanted to make sure I left you with provocations, because I think this is about ongoing work for myself, but for all of us. So the first one I've already said. I think that I will work on this, but I think others could also work on macro accounting and connecting that with what's happening in fintech. I believe that that is one of the avenues that should be trying. The second point is about crypto here. The big tech idea is has been very successful, right? And the text you should read is called The Californian Ideology. It is a quick read, non-technical, but it shows very clearly why tech thinks so highly of itself. And that is the moment we are about to live through, because crypto is being washed away, but their ideas are not gone. Their ideas have not been tested, and now they're getting built in closer into the center of the system. So I don't see a reason to think that tech will be stopped in its tracks. Therefore, we're probably going to learn these lessons the hard way. The lessons will be the same ones that we've already learned. Liquidity has a price, and that price can change. You need to understand the balance sheet. You know, the structure of the institutions matters. The lessons will be the same. However, they will have to be expressed in different language to teach another generation of people when they make these mistakes. We are the ones who will teach them. And so I think we should be ready for that. This is where I think we are headed next with the conversation about institutional DeFi, about central bank digital currencies, and the future of crypto. I think we'll still be having this conversation this time next year. And if you invite me back, I will be sure to come again. Feel free to get in touch with me. You can respond to the newsletters that you receive. There's the email address. I'm here. I get back to most people within a few days. The longer your question is, the longer you might have to wait, but I'm happy to hear from you. Thanks very much for your time.
Well, thank you, Dan, so much for everything you do and for this presentation as well. We have a couple minutes to discuss, so if anybody wants to come in and comment, you're welcome to. Perry.
So I'll just break the ice. It may be that this was talked about in the DeFi panel yesterday, which I unfortunately had to miss. But you're showing the Terra Luna business. Reminds me, I was in a closed workshop with the BIS and the IMF about stablecoin right as it was collapsing, right then in May. Okay, and I had already put in my PowerPoint a trainer diagram explanation of that. If we really believe, so you didn't mention the trainer diagram, so and I know you love it, so I wanted to bring it into the conversation here. That the if you think about liquidity in trainer kind of terms, okay, that this is about a dealer providing trading options, and that dealer is making an inside spread that's being supported by an outside spread somewhere, okay, and then you bring that and you say, okay, I understand how the algorithm works. Where's the outside spread? Okay, the outside spread in that algorithm is 0 and infinity. Okay, so just by construction, you can see that in the way the algorithm works. So that tells you, if you understand liquidity in a trainer diagram, you know that Terra and Luna is not going to work. It's not going to work. So there is some use, you know, the little simple little fundamental things. So it's not just, that's another little piece that's actually a pretty good piece of wisdom that you can use everywhere. Okay, and I just wanted to add that to the conversation, because you said they don't understand liquidity. That there is something that actually helps you understand liquidity. It's maybe not the end story, but it's a little piece of wisdom.
Raphael Schaap touched on it. She never actually showed the trainer diagram, but she has one in her work. She touched on it yesterday. So there is someone in our community who is thinking it through that way, and of course I agree completely, Perry. Should I call on people? Larissa, go ahead.
All right. Thank you, Dan. And I like the provocation of, like, we need more thinking around, like, how to apply some of the money view ideas to everything that's happening in, like, tokenization, programmability, because there's a lot of different projects around new platforms for cross-border settlement. And I put a paper in the chat that I would like specifically for people to, maybe it's a reading group session or like a separate session. So I think it's worth drawing out the balance sheets, thinking about it, because it does seem, and struck to Perry's point, that there's this desire to make liquidity free or approximately 0. So a lot of the projects are about basically making sure that there's intense competition between market makers to lower the cost as much as possible. So it's a question around like, what does that mean? What are potential structures? So would love, to build on the ask and, ask the help of others as well.
Absolutely. Absolutely. And making liquidity can't be free, and making its price artificially always zero is not going to work. It's going to make it blow up somewhere else. But we need to understand the design of the systems in order to be able to say something about how liquidity might move suddenly from one place to another or disappear suddenly. So I agree completely. I'll check out the paper. Thank you for sharing this. Oscar.
Yes, no, I just wanted to thank you, Dan, for the soon-parted blog. And you wanted the conversational legitimization, and I'm not good enough at sending feedback, but I'm giving it here now. And even especially when you were in Morocco and put on these 4 posts on the teaching there, was influencing the me at least in when me, Sasha, Jay, and Maria were teaching in Torino. Shortly after. So thanks a lot for all the effort you put in there. And then I'm going to point out like the phrase I liked a lot, macro accounting. Let's work on that. And then there was 2 small words, public assets, that you put, I think, on the last slide. And that's a good segue for my presentation tomorrow on the money view fiscal. That is, I think, a way to develop further this public asset part, and links to also Stefan's presentation before. So just a personal thank you for doing this on the blog, even though I'm not putting more than a small heart on the Substack app when I'm reading it.
Thank you, Oscar. I am seeing that there are not other questions right now. So why don't we wrap it up there? But I will thank you again for being here, and so many of you for reading. And I have found the greatest thing for me in my life, at least about Soon Parted, is to be able to write and know that people are reading. And the way that I know is that I hear back from you every once in a while. Oh, Alex has got a question. There's still time if you want to jump in. Alex is a dedicated reader.
Yeah, what are you doing next? What should we expect from you this year?
Expect from me, I don't know. I'm trying to figure out yield curve control. I'm 3/4 of the way through a quick like get my arms around it sort of post, and that is probably the next thing you're going to see. Beyond that, I found over the last year, that the first year there was a lot of infrastructure to build, and I was able to write really fast because I knew I had lots of ideas that have been lingering for a while, and I was building them and writing twice a week, and I could not do that for a second year. I'm really at like much more like once a week this past year. And why is that? I think it's because the low-hanging fruit is gone, because now I have to make up the new ideas, every time for every post, it's got to be new. I don't have a bunch more stuff that's waiting to come out, So I think it'll be led by events. I think we're going to see normal money market functioning returning in the dollar markets before too much longer. And I think that will come with some interesting news. I think there's big stuff coming in the Fed is suddenly into this regulated liability network, is now suddenly has a lot more energy behind it. Boston Fed's got Project Hamilton. So there's dollar CBDC projects that are moving along in some sense, combined with things that are happening all over the place in other jurisdictions. So I think we will learn some things there. I don't think we'll see a systemic change in that front this year, but we might see some big developments. And one of these days, we're going to get a proper liquidity crisis. And, one thing I know for sure is that we haven't seen the last of those. So whenever that happens, that'll be something to write about. So
can't wait.
I don't know. Yeah, I know. I look forward to that every day. Thanks, everyone. And I'll see you again soon.